This segment sponsored by Foster Financial. Welcome back to Women's Wealth Wednesday, which is an exciting day because we get to talk about finances and how they apply specifically to women. And joining me today is Caleb Doane, the Vice President of Foster Financial. Hi, Caleb.
Hi.
Welcome.
Yeah, thanks very much.
Yes. Okay, so we've been on this discussion about basic financial planning. And I know last time we talked about cash flow analysis. So what will we discuss today?
Yeah. So there are kind of a few key pieces of financial planning. Cash flow analysis, certainly one of them. The one we'll talk about today is a risk assessment. So it's identifying, okay, how risky or how conservative should somebody's financial plan be? How risky or conservative should their 401k be? And it's really an important part of financial planning because people kind of fall all over the spectrum there, and it has a big impact, especially when we kind of extend it out long term with a lot of time in the stock market.
Yeah, okay, so as people kind of decide if they're risky.
Right, yeah.
How risky they want to be, I like that word. How does that apply exactly to a financial plan? Like, do they build in their risks into the plan?
Yeah, so I mean, there's kind of a subjective part and an objective part when we think about, how growth-oriented or how conservative somebody should be. And usually this ends up, determining, okay, what percentage of their portfolio do they have in, riskier assets like equities, stock, and what percentage of their portfolio do they have in more conservative assets like bonds or CDs. So it's really that percentage that we're kind of looking to target. That's kind of the end goal of the risk assessment there. But there's this subjective side and objective side. For the subjective piece, we have them take a quiz, and it has kind of different scenarios on it. And one of the questions that I like in there is, if your portfolio lost 20% of its value, what would you do? And the options are, okay, I'd immediately sell and want to go to a more conservative investment. I'd stay the course. I'd want to buy the dip, when it's down. And it just helps us identify what somebody's kind of natural reaction is to that. And people have very different answers, and it can certainly impact what we do.
Well, it's funny because I'm sure if they took that test like a year ago,
right,
they didn't know they were going to be in that spot this year.
Yeah.
To make that decision. And I love when you said a risk test, it's not like would you jump off of a bridge. It's like literal. Literal financial decisions.
Yeah,
and so as people are thinking about just the fundamentals of a financial plan, and when you're putting in this risk assessment, what other areas of the financial plan is impacted by what they end up landing on for their risk value? Yeah,
I mean, it can ultimately determine, a kind of expected growth rate for the account. And so if somebody is extremely conservative and doesn't really want any sort of downside potential in their portfolio, there are certain, investment vehicles we can use for that, but they might, be exposing themselves to another risk. Maybe their assets aren't keeping up with inflation or something like that because, you're not participating in the stock market. So, that's why we like to have that kind of behavioral side. There's also more of an objective side too, which is, okay, actually, how much are you going to be relying on the investment accounts in retirement? What is your net worth? How much money do you need to pull out of the account every month for basic living expenses? Because, that essentially is pointing towards what's the time horizon on the money. And if somebody, is just living on their pension and Social Security and they really don't need to touch their investment assets, they can tend to, afford to be a little bit more growth oriented.
Right.
Because if the market dropped, 15 or 20%, obviously nobody likes to see that on their portfolio, but it's not going to negatively impact their ability to meet their basic living needs because all that's covered through pension and Social Security. And obviously, the other side of the spectrum, if you need to withdraw a bunch of money for a new home purchase in a few years, but you want to be really growth oriented, we're probably going to tell you, hey, we want to pump the brakes a little bit. We need to be a little bit more moderate or conservative with this money because if the market drops 20%, I don't want you to not be able to buy that house that you're planning on. So we have both those sides, and we update that, frequently too, because like you said, somebody can be optimistic and say, hey, I'd buy the dip, and then the market drops and they're like, whoa, I'm not sure if I want to do that anymore. So we certainly update that over time.
Well, that leads me to the next question that I have, Caleb. Since we're here, we have your expertise, okay, and like real life experiences.
Yeah.
So as you have been working with your clients, do you first find that people are more risky, or they're more conservative on average?
Yeah, I mean, on average, most of the people that we deal with end up kind of being moderate. I would say people are usually invested oftentimes a little bit more conservative than what they think, because over time we find a lot of people come to us, and especially with interest rates being a little high over the last few years, they have a ton of money in money market accounts, in CDs, in checking and savings, and we factor that in as a part of your portfolio because that's part of your kind of liquid net worth. And so someone's stock accounts might be 70-30 or something like that, which is usually an appropriate level of risk for kind of a moderate to growth investor. But then they have, 250 grand in a money market fund at their bank. And so we say, okay, that, brings your average, a lot more towards the moderate or conservative side. And so sometimes that's where we look to increase risk a little bit.
Okay, and then my next question is, if someone fills out that survey or they initially went with a more riskier option, what actually plays out when things do happen? Like, do you find that most people that chose risky stay comfortable being risky when the time calls, or do they kind of like, clutch their pearls?
Right. Yeah. I think I think this is where having a financial advisor can help a little bit too, because again, we zoom out, we look at that long-term goal, and we're not going to make somebody riskier than what we think that the portfolio can sustain. And so if somebody is risky and the account values drop like we've seen so far this year, then we can remind them, hey, look, this was what our long-term goal was. We're still anticipating a recovery. And then when we tend to focus on those long-term goals, it helps them kind of get through it. But if we find that they're really uncomfortable, once we do see a recovery, sometimes we talk about lowering the risk then. And we say, hey, remember you were kind of worried about that. Maybe we lower the risk level so if it happens again, you're not losing sleep over it.
Right. So I'm sure nothing really shocks you with your experience.
We've seen it all. So,
right. Yeah. Awesome. Well, thank you so much, Caleb. Great chatting with you.
Yeah, thank you.
And if you would like more information about Foster Financial or would like to give them a call, they offer complimentary consultations. We'll have their phone number listed below, and I'll see you after the break. This segment sponsored by Foster Financial.